Hey everyone, let's talk about the newer version of our Tradytics AI portfolios. We just launched this today, so I wanted to get a video out. These are very interesting and we have seen some excellent backtests, so I'm really hopeful this is going to keep working as we have seen it work in the backtests, and then we'll be able to make money off of it. So let's start right from the top and see what we have, how are these created, and how to best use them. So on the top we have the active trades. These are the trades that are posted by the system that we have active right now. These trades are posted every Friday after market close. So if you want to enter them, then the best time to enter these is the open of Monday, and you are always expected to exit them either at the next Friday's close or if your stop loss hits. But we'll talk about the stop loss and profit taking in a while. Now, first of all, how do we generate these trade ideas? These are 20 trade ideas every single week. So you have 20 trade ideas for the next 5 trading days. And that's where we have really good tools for day trading, but we didn't have a really solid tool for swing trading. So that's where these portfolios come in. How are these plays generated? So these plays are generated assuming that market makers or institutions always get an upper edge. And when I say that, what we do is we look at a lot of data from retail traders, and then we actually go inverse of that. And so let's assume there were retail traders have been buying, let's assume, thousands of dollars of calls over the last few days or over the last few weeks. Now we are anti-retail trader here because the hypothesis, and that has been tested in the backtest, the hypothesis is that retail eventually loses a lot of money. So you might have heard that 90% of retail traders lose money. If that's the case, then whatever retail is doing, how about we do the opposite of that? And we have a very data driven approach to test that. But here you have, let's say, these bullish ideas and these bearish ideas. These are coming from looking at the retail data and then going inverse of that. For each of these trade ideas, you have a symbol, and then you have the profit right now. So this, since today was the weekend, this will update as we go on into the week, and then new ideas will emerge here on the Friday close, on the next Friday's close. And so this is, again, this is 0 because these ideas were just posted. Okay, so we know how these ideas are generated. We know what are we seeing on the top. 20 trade ideas, 20 trade ideas every week for you to actually use. Now, how do we actually use these? Before that, let's look at the performance. So we have a Sharpe of 10, which is like a very, very, very high Sharpe. You'll rarely see it anyway, which is why I'd highly recommend you actually test this out either with paper money or with a very small account, and then see in a couple of months how these hold. That's what I'm going to do. I'll create one paper trading account, one real account, and then I'll start putting some money into these portfolios, and then I'll see whether the performance holds. And since these portfolios are posted every week, this performance chart is actually, each bar is 1 week. So what we do in order to get this performance is we take the profits for all 20 of these trade ideas, we sum them up, so that's a profit from 20 trade ideas, and then we divide that by 20. So that would be a normalized profit value from our portfolio every week. Now, you probably don't want to buy or short or buy calls or buy puts for 20 stocks, and that's fine. You can pick the ones you like the most based on technical analysis. This is very important. Please don't try to analyze flow for these because they're trying to go opposite to the retail. Sometimes you actually might see that the flow is actually going against these trade ideas, and that's fine. Always use technical analysis to make sure you are comfortable with the play, or always do your due diligence with technical analysis, not with options flow. Like, that's a very important point. Please keep that in mind. And then out of these 20, you always have to have an equal number of bullish and an equal number of bearish plays. Please keep that in mind as well. Now, why do we go both long and short? This is really evident in the last 1.5 years, because over the last like 1 or 2 decades, markets had always gone up, but now we've been seeing that that's not the norm. Like, especially these days, markets can go sideways, markets can go up, and markets can go down. So a short long or a long short portfolio which has both long and short positions actually benefits a lot both in bull markets and in bear markets and even in choppy markets. So if you break this portfolio performance into just looking at bullish plays versus just looking at bearish plays, you will actually see huge dips if you're just looking individually. But if you are going both long and short, then those losses are averaged out and the profits come out much higher, and that's why you see this clean curve. Now what are we seeing here? Each bar is the gains. Let's say we start with a 100k amount. For the first week we put all that 100k in equal chunks into these 20 stocks. Then whatever the profits are, we invest those back. So these are the compounded returns, and whatever profits we got from them, we are going to sort of put them back on. And if we keep doing that in a compounded manner, so let's say after 1 week we had 110k, we are going to put 110k next week, and so compounded returns. If we do that, then within 1.5 year, within 1.5 last year, you would have converted 100k into 200k. That's what the back tests say. Now these are just back tests obviously, and if you have been following Tradytics, you'll know that we do our best to do thorough back tests, but then we still advise that you test this out for a couple of months over the next few months with paper money, and that's the best idea, because things often look good in back tests and sometimes they can fail in forward tests. So that's what I'm going to do, but I really like these portfolios. Now, why is the average gain 0.88 when we are looking at 20 positions? Shouldn't it be like much higher? Because if you are going into 20 positions and all you are getting like in total is 0.88, that's not high. But remember that we sum up the profits from those 20 positions, but then we divide by 20 just to normalize everything. And 1% every week is not small, because let's assume there are 52 weeks in a year. You are getting 50% returns in a year with a 1% average gain every week, and that's very, very high. Don't assume that that's low. The accuracy is 72.15, which is again pretty high. The biggest win, the biggest week was 5%, and this is all shares. We are not talking about options contracts right now. And the biggest drawdown was about 2% loss in a week. All right, that hopefully should be useful. So now that we understand most of this, let's take a moment to talk about options. Now, everything we have done here is with stocks and with shares. Options are inherently very, very complex. So I'd highly advise, if you want to, let's say for bullish plays, you want to buy calls. One, do not buy weeklies. Please do not buy short-term contracts. Always do maybe 1 to 3 month out contracts. That's the best way. And second, have good stop losses, but I'll come back to stop losses in a minute. But just have enough time in your contracts, and then take profits, close them out every week, and then that could be a good way. But please do some thorough testing with options contracts before actually putting real money into it. With shares, we have the back test, so at least you have a lot of data based analysis, but we haven't done that with options because they are inherently very complex. You'll have to figure out the stop loss. I'll talk about the stop loss with shares, but you'll have to figure out the profit taking and the stop loss. But the data is all there for you to actually even go back and test. So you can build a really solid strategy on top of this. After market flow and after DEX, I really like these portfolios, and I think they're very valuable. Now, what do we do to get this curve? So if we don't have any stop loss, then what happens is there are some earning weeks, because we are not ignoring anything. So there are no filters there. We go into all 20 positions every week, and then we sum the profits at the end of the week. But with those weeks where there are earnings, or there are mostly just earnings, or there are big events, these stocks can actually go down quite a lot. So I was looking at the data, and like some stocks had gone down within a week like 30, 40, 50%. So in order to prevent all those huge losses, what you have to do, or what we have done in our backtest, is we hit a max cap stop loss of 10%. So if any of these 20 positions goes below 10% stop loss, then you have to exit that particular position right away. So that's your stop loss. If all 20 of them go 10% negative, then you have to close all 20 of them. But you have to like attach a stop loss for each position, not for the individual sum of profits. And since you are like splitting all your amount equally into these 20 positions, each would be, let's say, 10%. And that's what we have done here. When you add that stop loss, and since these plays are valid for 5 days, 10% is a very lenient stop loss. It's not like we are saying 0.5% and then just doing a results, because that will get hit a lot. 10% stop loss is something where if there are earnings, just ignore that stock because it can go down more than 10%. But generally a stock, if it goes down more than 10%, you will have an option to exit that stock during that 5, 8, 9, 10%, 12% and loss that the stock is having. So it won't be like a sudden move that you cannot catch except for earnings. So just please ignore them. Hopefully that makes a lot of these things clear. Now just let's just look at the distribution. So you can see the losses are minimal because we have a stop loss, and the profits are pretty good. Now I'm saying these you have to exit these positions every week because new positions are going to be posted. But what I have, and these portfolios follow exactly that, because we need a strategy. We can't just be random about things. But since people are going to be building their own strategies on top of this, I'd highly recommend just like looking at the data and figuring this out, because what I've seen is sometimes when these positions start to work, so let's say coin goes up 5% this week, you don't necessarily have to close that 5% position out at the end of the week. What you can do instead is add a stop loss 1% below that price. So add a stop loss at plus 4%. So if it goes down 1% the next week, let's just close it because you already have good profits. But sometimes these rallies can be prolonged rallies. So maybe it goes up another 5% the week after that. So then you have like 10% profits. So you can actually change a couple of these things in your own strategies, and that'll still be very useful. What we are really giving you are like 20 solid trade ideas that we have back tested, and that we have randomly picked like 5, 10, 20, 3, 2 trading ideas from there, and we have run back tests on them. And this is important, what comes out is the more positions you can go in, the better your profits and the more smoother the equity or the P&L curve. If you just pick one bullish and then one bearish, then since these are 20 positions, it might be the case that you've picked the wrong one, which is why you need to do some technical analysis. But if you just like pick all 20, if you can, that's like the best thing you can do. Pick all 20, put equal amounts into all 20 of these, maybe like 10 calls, 10 puts, or go 10 long shares and then 10 go short 10 bearish stocks. That works as well. But you have the data in front of you. Hopefully what I'm saying will help you sort of clearly understand everything. What this comes if you go into all of the 20 positions every week and close them out next week, or if the stop loss hits for any of these positions. But you can play around here. And then you can see again, some symbols have just been very bad. So these are total sums of these stocks for all the positions that we had over the last 1.5 years. And so again, UPST, I'd assume some of these were earnings, like some of these profits and some of these big losses were because of earnings. So I'd just suggest skipping weeks or skipping plays with skipping plays with earnings next week. And then last, we have all the bullish trades over the last 1.5 years. Again, 800 trades, 10 every week. And then we have all the bearish trades, and then these are all the active trades. Again, just 20 of them, and these were just posted today. I will change some of this stuff in the coming weeks, like add links to stocks dashboard if you just click here, things like that. But hopefully what I've described helps you start using these trade ideas for your own swing trades. I absolutely love the backtest. I absolutely love the total gains. 70% gains in 2 years is like out of this world, especially with this beautiful of an equity or P&L curve. Like who wouldn't want to convert 100k into 200k in 1.5 years? But again, please do your own backtest. Look at the data, see if it makes sense. Go to the charts, look at if you could have used these to profit. But I absolutely love them. I have done a lot of analysis over the last 70-90 hours, and I think these are very valuable, and I'll be using them like every single week. So if you have any questions, please let me know. But again, hopefully this is helpful. We will make more stuff on these. All right. With that, I'm going to end this video. But again, if you have any questions, please ask them. I'll see you guys around. Thank you so much.